The strong dollar is a house of cards that's going to kill inflation, but also kill the stock market. How does this happen? Why does this happen? What am I going to do about this? Stay right where you're at. I'm going to give you those answers right after this explosion. This is not financial nor professional advice. This video is for entertainment only. Hey everyone, I'm a retired psychologist who's a very active trader of stocks, and today I'm going to tell you how I'm handling this weird market. Inflation last month came in at 8.5%. They're going to come out with another CPI report on Wednesday, and that's going to be estimated to be at 8.1%. If it goes up equal to or above 8.5%, that will be horrific, and the stock market will crash big time. If it comes in 8.1%, let's say 8%, 8.4%, if it comes in that range, it'll probably not have too much of an effect, that the stock market will just continue to stagnate. If it goes below 8%, then that actually will cause a rally because there's so much bad sentiment in the market. The market is so bearish that any whiff of good news, such as inflation went down, or at least the rate of acceleration decreased for a month, it will be greeted with open arms, and the market will rally. It will be a short-term bull trap type of rally, so you don't want to get suckered into it, because we want to see at least 2 months before we assume any trend. I predict that it's going to be probably pretty bad, maybe not quite as bad as last month, but still bad enough that the market will continue to shake out and continue to go down. Why does the market go down with inflation? It goes down because Jerome Powell of the Federal Reserve has declared war on inflation. Their main weapon to fight inflation is raising interest rates. As they raise interest rates, that has a number of effects. One effect is that people will spend less. The increase in interest rates will increase mortgage rates, which are already over 5%, and that raises the potential of crashing the real estate market, or at least a slowdown of the real estate market. And also things like buying cars and stuff becomes more difficult for people. And we already have food inflation and energy inflation, and those are the two worst things that the Federal Reserve does not include in core inflation. So they call it the CPI lie, because it doesn't include the two things that you need the most to live. So it's really a distortion. So the way it goes is, to fight inflation, he raises the interest rates, and this has the effect of fighting inflation, but it also makes the dollar stronger. Other people in other countries want to buy our bonds when our interest rates go up because they get a better interest rate. I mean, Europe until recently was paying, it was negative interest rates. You had to pay the bank to keep your money in the bank. Can you imagine that? That also explains why stable coins and crypto are popular. They're just happy to have a currency that will stay at the same rate and not have a negative drag on it like it was in Europe for some time until recently. But as the U.S. raises its interest rates, other countries are raising their interest rates, and that's going to have a negative effect on the world. underdeveloped countries don't want us to uh, increase the interest rates, because what it does is it strengthens our dollar. And so we're able to buy things cheaper. That's why it fights inflation so well. We will be able to buy things from China cheaper, okay? And while it's fighting inflation and we are able to buy foreign goods cheaper, it crashes the United States economy. And that's because exporters in the United States, when you have a strong dollar, our products cost more to other countries, and so they're not going to buy our products. So it's cheaper for us to buy from them, but they're not going to buy from us because it's more expensive for them. And so you have this effect, and while they're not buying from us, United States citizens are buying less because they're getting squeezed by the high borrowing cost on cars and houses. So you have this double whammy effect. As the Fed raised interest rates, mortgage rates have gone up even more. And like I said, it's gone up over 5.25%. And so I like to play inverse funds that are shorting the mortgage bonds, and they're mainly shorting REITs, real estate investment trusts, and one that's a double leveraged inverse fund on the REITs, the REIT, real estate investment trust. The one that's double leveraged, its symbol is SRS, and it's gone up 27% since the beginning of the year. The other one is a little more risky simply because it's triple leveraged, okay? And its symbol is DRV, and it's a triple leverage inverse fund on the REITs. So you have your choice: double your fund or triple your fund. Okay, the DRV is probably a little more risky. I'm watching that one. I already own SRS. I'm watching DRV to see how it acts the next couple of days, deciding whether I'm going to jump in. But I think they've got a long ways to go up, and I won't sell them until mortgage rates seem to stabilize. And they probably will stabilize after we have a massive slowdown. And I hear whispers of it beginning to stabilize and maybe go down a little bit, but they aren't loud so far. But they'll get loud if the stock market crashes. That's my prediction anyway. I'm also using an inverse fund on the 20-year bond, and that symbol is TMV, and it's a triple leverage inverse fund on the 20-year bond. As the interest rates go up, the 20-year bonds will go down, especially because the longer the maturity, the more they go down. The bond, as the interest rates goes up, bond prices go down. It's such a weird inverse relationship. And then I'm doing an inverse on the inverse with this TMV. So it's hard to keep it straight sometimes. But it seems that has been a good investment. I mean, I started investing in this at 94, and it's into the hundreds, and looks like it's headed for 110. And it probably will go well beyond that, the way things look today. Thank you for watching and listening. Be sure to hit the like and subscribe buttons, and hit the notification bell if you want to be notified of future videos. And I will probably be talking about shorting the market with inverse funds on the indexes during the next video, simply because it's late Sunday night as I'm filming this, and I noticed that the market is already down like over 100 points, at least the NASDAQ is. So it should be a rock and roll day. We never know. Just because it's down now doesn't mean it can't rally in the morning, as we're finding out more and more. So we get these wild swings, which is sort of a day trader's dream. And when you're short in the market, you usually do this for a short amount of time because it's not a good idea to do this on a long-term basis, because you're going to lose, because the market generally goes up, except during time periods like this. And so it's a time-limited strategy. This is not financial advice. I don't know your personal situation. This is what I'm doing. I've been through so many crashes. I kind of got the hang of it and know what to do at the right time. So let's see how it develops. Bear markets rally viciously and they go down viciously. And it's harder to play a bear market than a bull market. Bull markets go up like an escalator. Bear markets go down like an elevator. Okay. Good luck with your investing. Thank you for listening, and I will plan to see you in the future. Bye-bye.